Welcome back to Legends. I'm Dr. Cal. Let's get right into this video. So the stock market today is actually mostly flat. The Nasdaq is down 1%, the S&P is down 0.7%, and the Dow is down 0.4%. Let's take a look at the different sectors. Energy leading again, lagging is communication services and technology, so it's a bit of a risk-off move again today. In fact, this whole rally to the upside has been mostly a risk-off move led by defensives, energy, and utilities. Take a look at the weekly performance. You can see that reflected here with real estate leading, utilities leading, consumer defensive leading, communication services, cyclicals, and tech, the risk on sectors, disproportionately lagging. Let's take a look at the stock market map and again look at this big cap tech, Microsoft, Apple, Google, Meta, and semiconductors, including Nvidia and AMD, all in the red. In a risk on move, in a rally, an uptrend, you want to see all of these huge red boxes turn bright green. We're not seeing that. Another major worrying sign, everybody, is this. Up top is the smart money, the high yield bonds. Down below is the dumb money, the S&P 500. And there's a sizable divergence that has developed today. This is the first day of this new divergence. And we can clearly see here, smart money is dumping. Smart money is selling ahead of that Fed meeting. And if we take a look at the 2-hour chart, you can see this massive divergence building now, with the HYG today taking out the prior low from Friday, while the S&P 500 is still holding on for dear life. Let's take a look at the 2-hour chart on the S&P 500. There's another divergence here that I need to highlight, and it's this. Look at this double top formation with a negative divergence on the PPO, a lower high on the PPO as the S&P made a higher high on Friday. Now, this divergence could be invalidated if we get a rally, a quick and dirty rally tomorrow that could invalidate this divergence. But if we continue to see choppiness, sideways movement, and even weakness, that's going to put a lot more weight on this being a double top formation and to expect selling to come, especially at that Fed meeting on Wednesday. We're already seeing the smart money dumping. In fact, this entire rally, everybody, since Friday, October 21st, this entire move to the upside has actually been fueled by a rumor, This article right here from Nick Timiraos from the Wall Street Journal. Nick is nicknamed the Fed's mouthpiece because he has a lot of insiders at the Fed that talk to him and leak info to him. Now, this little article on October the 21st, Fed set to raise rates by 75 basis points and debate the size of future rate hikes. This article hinted at the Fed potentially pausing or pivoting as early as next year. Now, as soon as this article came out, the market rallied. That Friday futures looked bright blood red. The market was actually ready to go down and close this gap. That article distorted the price action. It came out just before the market opened, about 30 minutes before the market opened, and this entire sell-off in the pre-market in the futures trading just spiked up and the market rallied like crazy. Unfortunately, the same journalist has now backtracked. He's talking about cash-rich consumers could mean higher interest rates for longer. So this is just pure manipulation. There is no other word for it. It is manipulation, totally legal, 100% legal manipulation. This article could have been a plant by the Fed to test the market reaction if the Fed potentially begins talking about a pause. And I'm pretty sure Jay Powell would not be happy about this reaction at all, because since that article came out, financial conditions have significantly loosened, and the Fed's entire job has been to tighten financial conditions to control inflation. And as long as financial conditions loosen, the stock market moves up, the bond market moves up, yields come down. That directly works against the Fed's job. So what are the chances that that Jay Powell will come out on Wednesday with a nothing burger, no talk of a pause, no talk of a pivot, just reiteration of the hawkish stance by the Fed? What do you think is going to happen with the stock market? Well, in most likelihood, the smart money knows what's going to happen because they've been selling, and I suspect the same thing is going to happen with the S&P 500. With all of that being said, be aware of a fake out on the day of the Fed meeting. We could see a massive green candle, a massive rally and an instantaneous soul-crushing crash just the next day. This exact type of setup happened right over here. May the 4th, market rallied on the Fed meeting. Next day, gap down, massive sell-off. So just be careful. This sort of thing does happen. With all of that being said, the technicals, just purely looking at the technicals continue to be bullish. We do have bullish momentum on the daily chart. On the 2-hour chart, we did talk about this really bad divergence, this really bad looking divergence. The only way for this divergence to break, to end, is for this to work out as a bull flag with the market rallying to the upside. There's still potential that could happen, but it'll have to be on some big piece of news coming out. Now let's take a look at the Qs. The Qs printed a negative 1% day today, but the Qs have begun forming somewhat of a more bullish looking candle, a hammer looking candle, while the S&P 500 has actually printed an indecision doji candle, more of an inverted hammer candle, while the market rallied, then reversed and closed near the lows of the day. So we might be seeing some relative rotation into riskier assets, but again, the HYG, the smart money, is warning that this rotation will very likely be short-lived. This bearish divergence between the smart money and the dumb money could continue throughout tomorrow. We could even see the S&P making a new high tomorrow as the HYG makes another lower high that will solidify this divergence and will increase the likelihood of a sell-off after the Fed meeting. Not necessarily the day of the meeting, but we could see that sell-off come on Thursday. Let's take a look at another significant chart. This is the Dow Jones. The Dow Jones is now less than 1% away from tagging this significant resistance line. We saw the market systematically sell off after tagging this resistance line, and we are likely going to tag it and sell off within the week. Let's take a look at another chart. This is the Dow Jones Industrial Average up top and the Dow Jones Transportation Index down below. This is Dow Theory. This is a Dow Theory chart, and Dow Theory says that if the market rallies, but the transportation index does not confirm that rally by making a lower high, this indicates weakness and warns of an upcoming sell-off. This happened systematically throughout this year. We had this rally back here when the market topped in early January. Transportation index made a lower high. The Dow Jones Industrial Average made a new high. This divergence led to this breakdown. We had another divergence right here where the S&P made a double top. The Dow Jones made a slightly higher high. The transports made a lower high and the market crashed. The exact same thing happened here. Look at this absolutely enormous divergence. Dow Jones made a new high. Transports made a significantly lower high. The market ended up selling massively. Another one right here, new high by the Dow, lower high by the transports. Market sold off yet again. And we're now seeing one enormous divergence. Just look at this massive divergence. It's even bigger than the divergence that we've seen before the market crash and before the beginning of the bear market in January. So be warned, we are likely at the precipice of a major sell-off in the next few months. Now, this divergence could continue for days or even weeks. And the Dow Jones Transports could even take out this high while the Dow Jones takes out this high. But at that point, we will establish a new divergence as well. We will still be in negative divergence. Let me show you that again. Boom, we move up, make a new high. Boom, we move up, we take out this high, but we fail to take out that high, and that will create a divergence. Let's take a look at the VIX. The VIX moved down today. It gapped up in the morning, but it steadily moved down as the market printed a indecision doji. We could now be witnessing the beginning of the VIX forming somewhat of a bottom. We do have a lot of support at these levels at 25 to 25 and a half. So we could still see the SPY attempt to rally one more time. The VIX move down one more time while the HYG continues to print this negative divergence. And that will likely signal the top and a sell-off. Let's take a look at the dollar index. The dollar index printed a massive green day today. Despite that, the S&P 500 managed to hold on somewhat. With that said, the dollar does look like it wants to bottom. We had a close outside of this ascending channel. Then we recovered. We made the bottom here. And we had 3 consecutive days of strength in the dollar. The exact same thing happened back here in August. And it did mark the top. We had a similar looking structure back here in May. The dollar bottomed, it printed a big green candle, and the market topped the next day. So the likelihood of the market topping tomorrow is now increasing significantly, with the negative divergence between the Dow Jones Industrials and the transports, as well as the smart money selling off, as well as the divergence on the 2-hour chart between the S&P price action and the momentum. We could still see one more push to the upside, make a new high as the PPO continues to print another divergence. And that could potentially mark the top as soon as tomorrow. Let's take a look at yields. Yields are actually weakening. We're still continuing to see weakening in yields. They're not looking nearly as strong as the dollar. We do have this big negative divergence on the daily chart, with the price action making a higher high and the PPO making a lower high, indicating that this is likely a medium-term top in yields, and that yields will likely continue to move down. Now, that's subject to what happens on the Fed meeting. We could still see yields shoot up on the Fed day or potentially after that. Let's take a look at the CPC put-to-call ratio buy and sell signal. This is my own variation of the CPC buy and sell signal, and this variation has been 100% accurate year to date in predicting market reversals. The classical put-to-call buy and sell signal is significantly less accurate than this variation. This particular variation I've tweaked specifically for this bear market, and that's why it's been incredibly accurate so far. By the way, if you're interested in getting this signal, I did make a video guide on how to set this signal up on a free TradingView account for the legendary members of our trading community. By the way, if you're interested, check out the link in the description to join. It's $30 a month if you go for the annual membership, and I do post every single trade and investment that I make in real time. In October, we opened and closed 10 trades and 9 were winning trades. Again, check out the link in the description if you like my work and you want to support me and my work. That's the best way you can do it. Now let's take a look at the earnings calendar. Today we'll have NXP, which is a chip supplier for the auto industry. So I'm going to take a closer look at how NXP does, because it's going to reflect how well the auto industry is doing, and that in turn reflects how well the economy is doing. Tuesday, we'll have AMD after the market close. Tomorrow, after the market close, AMD, Devon Energy, Airbnb. Before the market open, we'll have Uber, Pfizer, SoFi, BP Petroleum, and Eli Lilly. A lot of big names, mostly defensive and energy names, except for AMD, Uber, SoFi, and Airbnb. The rest are mostly defensive and inflationary names. Today, I opened a position in AMD with potential profit of 400% if this trade goes our way. Again, all the details of all of my trades are in the trading community. Check out the link in the description if you are interested. Now let's take a look at the economic calendar. Tomorrow, we'll have the ISM manufacturing PMI as well as the JOLTS job openings. Wednesday, employment change as well as the Fed interest rate decision. No surprise, it's going to be 75 basis points, but the Fed press conference is going to be the most important part of Wednesday. Thursday, we'll have the balance of trade as well as initial jobless claims, ISM services PMI, an OPEC meeting, which could drive volatility in the dollar index and the energy market. And Friday, we'll have the most important figures, the non-farm payrolls and the unemployment rate. The Fed is going to be watching this exact number. We need to see it starting to tick up. Otherwise, it means the Fed just needs to do more to slow down this economy and curb inflation. In fact, the Fed talked about unemployment rate going up to 5.5%, their target being over 5%. So we're still far away. In fact, unemployment has ticked down the last couple of months. We need to start to see this figure moving back up. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.